To order at 8:31. We'll start with the Pledge of Allegiance. And Julie, would you like to lead us in the Pledge of Allegiance? You're muted right now, so.
Yes, thank you. Happy to. All right. Where's the flag?
Oh, with us.
It's on my front door.
The United States of America.
And to the republic
for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Thank you.
Yes, we need to make arrangements for a flag.
Yeah. Okay.
On the screen.
So there has been no public comment because we would get it through emails. And so next on the agenda is the consent agenda. Is there any discussion and possible action and consent agenda meeting action? Seeing none, we can go ahead and approve it without, we could do a roll call for approving it or just approve it.
I can hear James's voice now saying you can approve it by unanimous consent.
Right.
All right, we'll approve by unanimous consent. So then we will move right into discussion and possible action regarding the presentation of the actuarial risk report. We would like to welcome Andy Young into the meeting.
And Paul Angelos and joining us today.
I thought it was Andy. Both of them?
Both.
Okay.
Yeah.
Okay, Paul Angelo and Andy Young, welcome.
Good morning, Catherine.
Hi there.
Okay. We look forward to your report.
It's interesting how people pop up in different places on your screen.
I know, isn't that funny?
Paul's way up there and Andy's way down there. Anyway, welcome.
Thank you.
Thank you. I'm working on a laptop, so I have to do this a lot, and it kind of scares people. So I will occasionally put my turn my camera off, but I'm still here.
Okay.
Okay.
So Paul, you will put the report on the screen, right?
I will.
Okay, thank you, Paul.
Here we go. Can y'all see that okay?
Yes.
Good. Let me get the box out of the way. Okay. So this is your first. This is Paul Angelo with Siegel, and I'm joined by my colleague Andy Young. We're here to present the risk assessment report for the Mendocino County Employees Retirement Association that is based on the actuarial evaluation 2019 that we presented to you last fall, at the end of last year. In that report, in that actuarial evaluation report, there is a section on risk assessment, but it's more of a talk piece. And as we will discuss, the standard of practice, actuarial standard of practice that requires a risk assessment doesn't compel you to do a quantitative version, but it is encouraged, and there's some guidelines on that. So what appears in your actuarial evaluation report, which is not this, that is sufficient to comply with the letter of the law of that standard. But this report here, take this down a little bit. This report here goes into much more detail, and in discussion with Mr. Wilbanks, it was decided that it would be good for the board to have this more complete assessment. Now, the way this is set up, I'm just going to scroll through here. There's an introduction section. This talks about the purpose of the report. This does mention that there is a new actuarial standard of practice, ASOP 51, which went into effect with last year's valuation. And it does require, you notice it says here, the actuary's initial assessment can be a strictly qualitative discussion, which is really what you'll find in the valuation report. but also may include quantitative numerical demonstrations where informative, and that's what we'll be presenting today. Now, in this summary section here, I'm going to go through pretty quickly because everything that's here is presented in much more detail in the body of the report, and so we will really be focusing there in the body of the report. So we talk about some of the historical factors. Andy's going to walk you through, and we found for our other systems that have had us do this kind of a report, this is really where a lot of the discussion occurs, because one way to understand risk is to see what historical risks have played out to get you where you are today, really. So we will look at that both in terms of contributions and in terms of the funded status of the plan. And then we do, this is just a glimpse at that history. You'll see, for example, now this is just a super summary, right? We'll have a table that shows all these years, but if we look 10 years ago, the plan was funded 69% on a market value basis, 79% on a smooth valuation basis. That's because this was still after the housing crisis, and the market values were still depressed. And what you might say is, you know, it looks like in 10 years, the funded ratio has remained fairly flat. And even on a smooth basis, it's even gone down. Now, you got to think of this 79 as being more like the 70. So it really has been fairly flat. And we've had good returns. So why is it that the funded ratio has remained flat? Well, we're going to show you a history graph that will go directly to that question. Then we'll flip, first do the past, then we will flip and look forward and look at projections of funded status and contribution rates. And we have both what's called a deterministic scenario projection and then also a stochastic projection. This again is just a super summary of the deterministic scenario test, as it's called. What happens if in 1 year we earn either the assumed 7%, or we earn double the assumed rate, or we earn 0. And we'll see how that affects future employer contribution rates and future funded status. And then just for Mendocino Sarah, we were also asked to look at the effect of recently determined future salary increases. And Andy will walk us through that as well. And then we have a stochastic. Now, we don't try to summarize the stochastic here. We just have one sentence on it. But stochastic allows you to say things like, there's a 50% chance that the employer contribution rate will be in some range. It will show graphs where you can see really what is the distribution of expected results going forward. At that point, we'll probably be all worn out, but we'll talk a little bit about plan maturity measures. And then this is also gives an idea of why it is that the plan's costs seem to be more sensitive to external events. You know, assumption changes have a bigger impact than they used to, that sort of thing. So before I jump into hand this back over to Andy for the historical trends, let me pause. Andy, anything you want to comment in terms of introductory or summary here?
No, I think Paul, you did a good job. Yeah.
Okay, and I also want to pause, Madam Chair, as far as if any of the trustees have any questions at this point, or we'll just keep pounding through the thing.
Excuse me, it's Jerry. I have a request. Since I can see the report, but I can't see exactly what you are talking about. If you would give me a page number, please, as you work through the report.
Thank you, Jerry. I will certainly do that. Thank you. And Andy, if I forget, you remind me, because I get criticized for that all the time. You're only the 100th person to tell me that. I should know better. Thank you, Jerry. So Andy, moving on to page 6, Andy, why don't you walk us through the historical trends that we've looked at, and you just tell me when you want me to scroll the page any further.
Yeah, I think that maybe rather than to read the description, perhaps we can go to the graph on page 7. I think as Paul has indicated, now we are looking at chart number 1. As Paul has indicated, we were looking at a brief summary of the history of the funded status. As the trustees will remember, the funded status is really calculated by taking a look at how much assets we have and dividing that by the liabilities. In our valuation reports, we always have 2 funded status. One which we use the same measure, smooth value of assets that we use in the funding valuation that Paul was alluding to. So in that case, you would be looking at the line which is in blue. So you can see that at the beginning of the 10-year period in 2010, the funded status was 80%. And then if you look at the funded status, which was now developed on a market value basis, then you see the 69, close to 70% funded status that we have developed in the kind of reddish color. As Paul has indicated, in the 2010, we were still digesting somewhat the market losses from 2008 as well as 2009. So as we will see in the later page, you will see how assets moving, even though that allows time for the employer to, let's say, absorb and absorb the bad news and digest the losses. But what that means, though, is on a funded status basis, if you look at the graph, it would really take 5 years for any bad news to make it through the system. So, of course, it would work the other way. If we have good news to bring in, which is what happened after the market downturn, we have substantial market rebound. It also would take 5 years for those market gains to make it through the system. So if you look at the line graph, then you can see that the funded status really have, I'm now looking at just the blue line for the time being. You can see that on a smooth value assets basis, the funded status have really gone down from 80% to about the 71% that we have in the most recent 2019 valuation. And in the next page, and again, maybe without giving you in further suspense, the reason why the funded status really have not gone up, but rather has come down, are really because of 3 assumptions changes, a triennial experience study assumption changes that the board has approved at Segal's recommendation over that time period. So all of those reduction in the funded status really can trace its roots back to the assumption changes that are deliberately made by, recommended by Segal and made by the board. Now, if we look at the actual dollar amount of the unfunded liability, now you can look at the bar graph. You can tell kind of a similar story. At the beginning of the 10-year period in 2010, if you look at the smooth value basis, the unfunded liability measured on a smooth value basis, the amount of the unfunded liability start off at about $92 million. On the market value, it's about $135 million. But at the end of the 10-year period, again, the amount of the UAL, the unfunded actuarial, the accrued liability has gone up as a result of the experience studies that we went through, that we recommend more conservative actuarial assumptions. So turning to page 8, please, Paul. So on page 8, we actually saw how those unfunded liability actually creeps up over time. So on this page, you will see that assumption changes corresponds to the purple line on this page. So if you look at the last, say, the changes over the last 10 years, you can see that the 3 major assumption changes that took place was first in year 2011. I'm just using interest rate as an example when we recommend and the board approved our recommendation to lower the investment return assumption from 8 to 7.75. And then that happened again in year 2014. This time, though, when we make the recommendation to change just the investment return assumption, the assumption was changed by 50 basis points, 0.5%, from 7.75 to 7.25. And then another change took place in 2017 at our request, which was approved by the board, to go from 7.25 to 7%. Now, the board may, something that I forgot to mention, even though this is based on the snapshot of the assumptions and the changes that have taken place as a result of the 2019 valuation. But when we go through and look at some of the projections, we actually have taken into account also the assumption changes that were just recently approved by the board at the June meeting. So because this is still a snapshot, at least for on this graph anyway, through June 30, 2019, we have yet to bring on the other reduction, the most recent reduction in the investment return assumption to go from 7%, as the board may remember, to 6.75. So we would anticipate that the next time when we update this report, which would be about 3 years from now, we would be bringing on another line, another bar, and then you would expect to see another bar with a lot of purple in the up direction, which increase the unfunded liability above the x-axis.
Say, Andy, I hate to put you on the spot. Do you happen to have, I know we estimated the impact of the assumption changes on the unfunded. Do you happen to have that at your fingertips?
Yeah, it's about $13 million, Paul.
13. Now that's quite a bit smaller because we're looking here. I mean, this one here in 2017 looks like it's around $30 million. So we'll see a purple bar, but it's not going to be as big as this last one. Would you say that's true?
Yeah, that's right. That's right. I think that what happened was, even though we have only included the investment return assumption, which have tend to account for the significant or the lion's share of the cost increase, but fortunately, when we did the 2020 experience analysis, when we recommend the reduction in interest rate, we also find the opportunity to actually reduce the inflation assumption, which at least based on the COLA cost of living adjustments that the county has approved, the other employers have approved, provides a little bit of an offset to the cost. So you're absolutely right, Paul. In that case, it does result in a smaller, but nonetheless still an increase in the unfunded liability.
And just some little commentary on this graph. I'm constantly asked, both by trustees and also in sort of in conferences. The markets have been so strong the last few years. Why hasn't the funded ratio improved more than it has? And we really have, in effect, spent the recent market gains. You can see this kind of tan number. Those are investment gains. We've really spent those investment gains, and not just this system, but all public systems across the country, on strengthening these assumptions. And that is very prudent, but it's one of these things where no good deed goes unpunished. You take the right action to keep the assumptions appropriate, but it does mean you're remeasuring your liabilities. So I think this in a snapshot really shows how the prudent action by the board has actually led to fairly flat funded levels, because basically, as I say, we're spending our investment gains on assumption change.
Yeah, and I think another point that would be worth noting, still on chart number 2 on page 8, though, is on the light blue color. So this happened in year 2011, for example. So we label this as what happened when we have even when the county and the other employers were paying the unfunded actuarial accrued liability, the UAL contribution rate, there was still an increase in the unfunded liability. And then the board may remember Paul and I said several years ago, we were going through the review of the actuarial funding policy. So what happened was, because we take the unfunded liability, and because we amortize the unfunded liability as a level percentage of payroll, assuming payroll will grow, at least back in the most recent evaluation, at an assumed rate of 3.5% per year. So what happened is, under that particular level percentage of payroll amortization methodology, in the first several years, especially when the unfunded liability payment period was basically lengthened to 30 years, it would result in a so-called negative amortization. So non-technical definition would be, even though when the county and the other employers are paying the UAL contribution rate, at least when the unfunded, when the initial payment period is relatively high, it will result in actually not paying off the principal, but the interest, and therefore we are adding more to the principal. Now, it's not going to happen now that the UAL period, I think we said in the report, is down to about 20 years now, and especially for any new layers of gains and losses, those are amortized over an 18-year period. So again, it will not happen going forward. We don't expect that to happen going forward, but nonetheless, if we go back and look at the history of the fund for the last 10 years, there were a few years, although the amount of negative amortization, the addition to the UAL, in spite of the employers paying off the UAL rate, gets smaller and smaller over time, but you don't get to see no negative amortization until around year 2015.
And I think that's striking on this graph. I mean, you couldn't draw more. If these light blue things, it's the same one in each year. They're not lined up very well because of other things going on. But here, 2011, 12, we're still in that negative amortization period. And we told the board, though, as the amortization remaining period on that restart layer, as it gets shorter, you're going to go from negative amortization. That's this one, this one, this one. And then eventually, look, you start to get a little bit of positive amortization. Oh, sorry, still negative amortization here in 15, a tiny bit here, pretty much flat in 17. And then look, in 2018 and 19, we start to see positive amortization. So right here in 2017, Andy, I think you'll agree, is where we go from a lot of negative amortization in 11, 12, less negative amortization in 13, 14, tiny bit of negative amortization in 15, 16, pretty much break even. You can't even see the light blue in 17. And now we see the positive amortization starting to emerge. And I think, Andy, we would expect that that light blue is going to continue to get larger as we move forward and as that restart layer, as we move more and more into positive amortization territory.
That's right. That's right. Yeah, so I think the other punchline that we said in the written report has to do with the fact that if you look at the at the purple color, those are the assumption change layers. Again, if you add them all up, they add to about 100 million, over a little bit over $100 million, which more or less really account for the growth of the unfunded liability from the beginning of the 10-year period in year 2000 all the way to the end of the 10-year period in year 2019.
Right. So it's because basically everything else kind of cancels out, right? There's above the line, below the line, but boy, those purple bars just jump out at you.
That's right.
Yep.
So unless there are any questions, we can take a look at the contribution rate impact. So we would take a look at the graphs on page 10. The contribution rate on this page, I'm now looking at page 10 on chart number 3. The contribution at the beginning of the 10-year period, as Paul has indicated in the summary page, is about 19% of payroll. At the end of the 10-year period in year 2019, the contribution rate for the employer was about 35% of pay. You notice, though, that if you look at the kind of orange-ish color, that's the so-called normal cost rate. So that's the cost that both the employer and, for that matter, the employee have to share to contribute in order to provide the active employee with an additional years of service. So that's the cost that would have to be paid, even when the plan, let's say, were to be 100% funding, when we have sufficient assets to pay the liability. However, in this case, we do not have enough assets, so that's why when we were looking at the two charts a few minutes ago, we have an unfunded liability. So the board has a payment plan. It would take the unfunded liability and pay it off over a certain number of years. And as I indicated, any new layers of unfunded liabilities are now being paid off over 18 years. And any of the older layers are paid off at the respective 18 years, although the original unfunded liability was still paid down at the rate of 20 years. But in any event, if you look at the light blue, that's the unfunded liability, and that really is the part of the contribution rate that have been increasing from year 2010 to year 2019. So in other words, another way to say this is, if you look at the orange-ish color, that's the normal cost rate, you will see that, well, it's kind of, it's very flat. As a matter of fact, in the first maybe 5-6 years, there was some increase. However, after 2013 or so, then there was a somewhat of a downward trend. Actually, the increase can also be explained to some extent by the change in the actuarial assumptions when we were talking about the investment return assumption coming down from 8 to 7.75, and then 7.75 to 7.25, and 7.25 to 7. Not only would it have an impact on the unfunded liability, it would also have an impact on the normal cost, which is to increase the normal cost. However, on the other hand, if you start looking at year 2013 and pay attention to how the purple has trended slightly downwards over time, and that's really as a result of a pension reform change. It's the California Public Employees Pension Reform Act of 2013, where the state really has come in and effectively mandate Mendocino County and basically all the other counties plus some other CalPERS agencies that there needs to be the same pension benefit formula, one formula for our general members and one formula for our safety probation members. So as a result of that mandate, which provides really a lower cost pension, lower cost benefit for those employees who entered the plan on or after 1 month of 2013. As a result of that reform, now we are seeing actually a slightly downward trend on the normal cost rate, which we have calculated for the plan as a whole on this page. Now, notice that the normal cost rate continues to trend down, and the question could be asked, okay, well, so exactly when all of our, say, legacy members, employees who entered the plan prior to 1/1 of 2013 leave the system, what would that normal cost rate be? So we'll have a number coming up when we go through the projections. But at least for the time being, the difficulty that the employers have to face is the increase in the unfunded liability contribution rates. And again, all of that increase in the unfunded liability page could be explained by the change in the actuarial assumptions approved by the board, which we can see actually if Paul, if I may ask you to turn to page 11. So now we are looking at page 11, chart number 4. Again, I think maybe it's very similar to, and maybe even more dramatic when we compare the change in the contribution rate on this page versus the change in the unfunded liability on the previous page that we were looking at. By far, the purple, which is the change in the actuarial assumptions, basically dominate everything that you see on this page. I think as Paul has indicated, there were some experience gains loss items, investment losses, investment gains, or salary increases coming in less than expected, COLA increases coming in less than expected. They kind of cancel each other out. But if you look at this page, you would definitely notice that there are just a lot of purple. And as a matter of fact, if you look at the assumption change that took place in year 2014, just to look at that change all by itself has an impact on the contribution rate, eyeballing the number on this page of well over 7% of payroll. So if we look at and see how the contribution rate on the previous page changes from 19 to about 35% of payroll for an increase of about 16% in total, going from, again, 19% on page 10 at the beginning of the 10-year cycle to 2019, 35% at the end of the 10-year cycle for an increase of 16%. So now if we go back to 11, and there's a text in our written report, so that 16% increase in the contribution rate for the employer can be entirely explained by the 3 sets of actuarial assumption changes that took place within a span of a short span of 10 years during the 3 triennial experience studies. And again, this is not even including the most recent assumption changes that Paul and I presented to the board at the June meeting, which again increased the contribution rate, and we would say that in the report, by another 2.5% of payroll. So this would be,
still, as just like before, Andy, the 2.5 is not as big as the 2017, which looks like was about 4%.
That's right. That's right.
Okay.
Okay.
It's Quincy. I have a question. On these last 2 charts, is there anywhere on those? I understand the difference on the cost where it had an impact regarding the PEPRA members, the newer members after 2013. It's also my understanding that when that was adopted by our board, by the Board of Supervisors, that it voted on that those PEPRA members would not be receiving a COLA in retirement. Is that reflected anywhere on here, or would it be in the future assumptions that we're getting into next?
Yeah, it's really in the future when we do the projection. So I think the one item that we can use to answer the question is on this page 10, whereas in year 2019, the normal cost is still the purplish color, the greenish, the orangish color, indicate that the normal cost rate is still about 10% of pay. So at this point, I think we might have about a little bit over 1/3 of our members who are PEPRA members and 2/3 in the legacy group. But as time goes on for the next 20 years, you would expect to see, and you will see the normal cost rate, which is made up of still predominantly legacy members, continue to trend down such that at the end of the 20 years, that normal cost rate actually will drop to below 9%. So you're quite right that I only mentioned the kind of one-size-fits-all formula, one formula for the general employees, one formula for our new safety and probation employees going forward. However, the other change that was approved by the Board of Supervisors was also to implement a no COLA policy. So those employees who entered the plan after 1/1/2013 are not expected to get any cost of living adjustment. So those two factors combined together will actually produce a reduction in the contribution rate, but very gradually over time, such that in about 20 years in the graph that will be coming out when we see the projection, the contribution rate for the normal cost will go down from a little bit over 10%, which is what it is today, to about 9%.
Andy, I have a question about that. My understanding is that the employer is still paying into the COLA contribution for the PEPRA members, even though it is not expected to be paid to those members.
Andy, let me ask you, this also goes back to the earlier question. Isn't it true, now check me on this, when we calculate the normal cost for a PEPRA member, we are anticipating the fact that that member is not going to get a COLA. That is calculated as part of the new member's normal cost. And if that's true, well, I guess what I'm trying to say to the earlier question, we don't have to wait for the PEPRA member to retire before the cost savings of there not being a COLA shows up. That's baked into the lower normal cost for the new member. And if that's true, then to the second question, I think it would be that the employer is not pre-funding a COLA for the PEPRA members because they're not going to get one.
That's right. That's right. Yeah. So when
Can I make a comment here?
Yeah.
The required contributions for the COLA, though, those are spread out for the employer across all of payroll. So it may look like the employer is paying COLA contributions for people who are in PEPRA, but that's actually part of the COLA contribution for the pre-PEPRA membership. It's just that it's being spread across the payroll as a whole for the employer contribution rate. Is that correct?
Yeah, yeah. So I think this goes back level percentage of payroll pay method for amortizing the unfunded liability. So what happened is we know that the members who entered the plan on or after 1/1/2013 will not get any cost of living adjustments, will not get any COLA. So that's built into the normal cost rate. However, that normal cost rate is only lower for the members who entered the plan as a PEPRA member after 1/1/2013. So when we're still looking at the average of the aggregate normal cost rate on page 10, which is about 10%, a little bit higher than 10%, that's based on still a lot of legacy members, relatively fewer PEPRA members, but the reduction in the normal cost rate as a result of the lower benefit and the no COLA provisions found in the PEPRA for the PEPRA members, they have already been baked in. But that's that they're not as many of those members compared to the legacy group. So over time, we would expect to see some of our legacy members retire. They would be replaced by the PEPRA members. So that's why we would expect to see more and more savings over time, which brings down the normal cost rate. So going back to the point that Doris, you make, is that we're absolutely true that when we develop a unfunded actuarial accrued liability UAL contribution rate for the board to approve and for the board of supervisors and the employers to pay, that rate is paid based on the PEPRA members as well as legacy members alike. So because the plan is an unfunded liability, it's everybody and the employer is paying the same UAL rate for those employees. So that UAL rate, which has some catch-up contributions required to pay the UAL for the COLA benefit, is now being utilized to reduce the unfunded liability for our legacy members.
So I have a question. Wouldn't another way of putting that, I think you kind of said that, is the teal color part of the bar, which is the unfunded liability, that's spread out among by the employer among all employee payroll. So if a particular position happens to be filled by an employee who's a PEPRA member, this is the money that the employer is setting aside into the retirement system in theory on behalf of that employee, but really in the case of the PEPRA member, much of that is actually being put into the plan on behalf of either retirees or on behalf of legacy employees who are working for the whole county as a whole. So the employee is not contributing towards a COLA that is not going to the PEPRA employee, but the employer is contributing towards the COLA of PEPRA, non-PEPRA legacy employees, whether they're retired or still working for the county. And it just gets spread among all employees. So all departments are contributing towards that cost.
That is correct.
And, you know, when you look in the, again, in the valuation report, we break out the contribution rates into basic and COLA, and we break them out into normal cost and unfunded. And so I guess what we're saying is for a PEPRA member, their normal cost is not going to have a COLA component, but their unfunded is going to have a COLA component because the unfunded due to the COLA is spread over all payroll, PEPRA and non-PEPRA, which is what the gentleman just said. Yeah. But you're right, this blue bar here is basically the same for everybody. It's only the normal cost where you have a different normal cost for PEPRA versus legacy. Okay. Yep. Any other questions on the history charts here, either the unfunded one or this one here? I'm on chart 4, which is page 11. This one, which is the history of the changes in the employer contribution rate. Okay, Andy, we keep going?
Yeah. So I think at this point, we know that at least from looking at the history of the fund for the last 10 years.
I'm on page 12 now.
I know that the assumption changes dominate the conversation as issued on the unfunded liability, on the increase in the unfunded liability, because it almost accounts for the majority of the change in the unfunded liability. And the assumption changes account for the entire increase in the employer's contribution rate over the 10 plus years. So as part of the risk assessment going forward, we actually will be spending a fair amount of time looking at what could potentially happen if there were to be be it good or bad market experience that the fund may run into going forward after year 2019 valuation. So Paul has indicated early on that in order to answer that question, we have prepared 2 sets of projections or illustrations going forward. One is the so-called deterministic projection, where we have gone ahead and take the 7% investment return assumption. At least it was the assumption used in the 2019 valuation before the board moved to adopt our recommendation to lower that assumption to 6.75, and then try to illustrate how sensitive that change, just a 1-year change in the market experience, could cause the contribution rate, the unfunded liability, and the funded status of the plan to change in the next several years. So for that, we have looked at on the top of page 14, 3 different scenarios. So the baseline, again, still based on the results from the June 30, 2019 valuation, we expect the fund to earn an assumed rate of 7%. So the question we try to illustrate is, well, if the fund basically the return for the year were to come in flat, meaning that the return came in at exactly 0%. So what kind of a impact that would have on the 3 measures, the funded status, the unfunded liability, as well as the contribution rate for the employer when we do the valuation as of June 30, 2020, and when we bring it to the board for review and approval later in the fall of this year. We also have put together another scenario, which I don't think is going to happen, but at least we want to try to provide the employer an idea of how, again, sensitive these contribution rate would be if we were to have a good year. For example, if the rate of return for year 2019 were to come in at double the assumed rate of 7%, meaning at 14%, how is that going to change the funding status, the unfunded liability, as well as the contribution rate requirement for the plan? And so now before we look at the charts, we can see in the middle of page 14, we have a table. So for 2020, if the return were to come in, I'm going to look at the baseline first. If the return were to come in at 7%, then for the year 2020 valuation, we would actually expect the contribution rate to go up by 2.2%. So that's the case even when we expect the fund to earn exactly 7%. And then as we explained in the report, the reason why, in spite of a break-even year, right, if the fund were to earn 7%, why would the contribution rate still go up by about 2.2%? Really has to do with the fact that we had a assumption change that we recommend as part of the experience study. And we mentioned in this report, as well as the answer to Paul's question from early on, what's the contribution rate impact? That impact is expected to be about 2.5% of payroll. So bottom line is, if the fund earns 7%, if there were no other gains, actuarial gains and losses, we would actually have expected the contribution rate to go up by 2.5%. However, as we explained in the report, the increase is expected to come in slightly less, and that has to do with yet another year of hiring of the PEPRA members, and that's why the contribution rate is only going up by 2.2. So maybe, Paul, we can take a look at the graphs, and then we can see how that contribution rate not just is going to trend over 1 year, but over time. So
Thanks,
we can turn to page 16.
Yeah, and actually, it's always a little tricky doing this kind of a study when you know that you have a change in assumptions. So what we've chosen to do here, even though as we project the numbers forward, we did that using the new assumptions. That's why you see this 2.2. But when we were picking what scenarios to use, since we're talking about returns during 19-20, we used the old assumption. So if we were doing this next year, scenario 2 would say 6.75, scenario 1 would say 0, and scenario 3 would be, I guess, 13.5. So this is kind of a mixture of the old assumptions during the 1920 year, but then we use the new assumptions going forward. Andy, is that correct?
Yeah, that's right.
Okay. So now I'm going now to page 16, which is chart 5, where we have a graph of these projections. I just have to go one more click. There we go. All right. So, these, first of all, we see 4 lines on this graph. There's a red square, there's a gray circle, there's a blue diamond, and there's a green triangle. So imagine first, just ignore the gray circle. Pretend the gray circle is not there. And all you would see is 3 lines. The one in the middle is the blue diamonds. That is scenario 2, which says that we earn the assumed rate of 7% during 1920 and continue to earn that the new assumed rate of 6.75 thereafter. So that's our baseline scenario. So if you just look at that, well, first you'll see from 19 to 20, the blue line goes up. That's the increase mainly due to the assumption change. That's that 2.2%. And then because we have we don't have any new market gains or losses, right? Then this blue line, you see how it just gradually trends down until 2031. That is the PEPRA effect. That is the less expensive, lower benefit formula, no COLA PEPRA members replacing the relatively more expensive legacy members. And then under your amortization policy, if there are no future gains and losses, by 2031, you will have paid off your unfunded, and then we see the rate drop down to essentially the normal cost rate. Now, Andy, check me on that. That at 2032,
yeah, it's not quite there yet. I think
not quite there yet. Okay.
Yeah.
So I stand corrected. This is when you have paid off that big restart layer. Is that true, Andy?
I think some of the assumption changes layers, because the restart layer has the longest remaining period, which is 20 years. So so I think the restart layer will finally be paid off when we are way out there in about year 2038. Yes.
All right. So I stand corrected. You have remember those big increases due to assumption changes. Those are amortized over 18-year periods, right, Andy?
Mm-hmm.
And so what we're saying is here in between 2031 and 2032, we will have paid off one of those big 18-year amortization layers.
Right.
And then you can kind of see, look, 3 years later, there's another drop. That's probably also because we paid off another of those amortization layers, those assumption change layers. And then we keep paying off different amortization layers till finally 2038, we really pay off the unfunded, and then it drops down to the normal cost. You can see I was sort of checking myself. I knew the normal cost wasn't 27%.
Mhm.
So when I said that it was that we were at 100% funding in 2031, that's obviously not true. It's not until 2039 on this deterministic projection that we're expected to be 100% funded, and that's when we drop down to the rate of just the normal cost, which again is around 10%. So I apologize for that misstatement. Andy, we have a couple other projections, but do we want to look at those first, or should we talk about the gray circle before we move on? Why don't we take a look at the others just to see what we're going to look at, and then we'll go back and pick up the salary change. Is that all right, Andy?
Yeah.
Okay. So now I'm going to chart 6 on page 17. This is the funded ratio. And again, this simply says that, well, if you have a good year, which is the green triangles, you're basically your progress toward 100% funding is going to be accelerated. And if you have a bad year, which is the red square, it's going to be slowed down. But they all end up getting to 100% funding in 2039, because that's when your last current amortization layer is fully paid off. I'm gonna go to chart 7 now. It's sort of just like chart 6, but it's upside down, because instead of being the funded ratio, this is now the dollar amount of unfunded liability. And you can see we're heading for 0. Same idea. The blue triangles in the middle, that's with no gains and losses. That's your funding policy, systematically having your employers pay off the unfunded. And again, if you have a loss in 19-20, that's the red squares. That's going to bow the line up a little bit. If you have a gain, it has it bow down, but they all end up in the same place. Now, I always like to have Andy explain to me, Andy, why does it look like we overshoot the 100% funding? We actually end up with a surplus out in 2039.
Yeah, I think this has to do with the fact that when the board approved, for example, the contribution rate in the fall of 2019, as a result of us conducting the June 30, 2019 valuation, those rates actually will not be paid until the fiscal year we are in right now, right, the 2021 fiscal year. So imagine in this case where the unfunded liability will continue to be paid off, and then after it is paid off, we would be setting the contribution rate in the last year when there's still unfunded liability. We would ask the employer to pay the rate, but only until 12 months afterwards. There would be a year where a UAL rate would continue to be paid, even though that UAL would have been fully paid off. So I think it's a 12-month delay between the rate setting and the rate implementation. When we are looking at way out there in the very last period when there was just one more year of UAL that needs to be paid, when that rate actually is finally paid 12 months later on, technically that UAL has already been paid in the prior fiscal year. So.
Right. And by the way, I want to really make clear to the trustees, anytime you're looking at projections out this far, out 20 years, something will have happened between now and then. So I don't want you, there will certainly be other elements of unfunded that will have been created between now. So that's sort of what you would normally see in this set of scenario tests. We use these scenarios with a lot of clients. We're kind of big fans of this scenario 1, 2, 3 for a couple reasons. For one thing, I'm going to go back to page 16 where we're looking at chart 5, which is the employer contribution rates. Because we are showing the effect of only 1 year of investment return higher or lower than assumed, your employers can actually use this to sort of do some interim budgeting. So if it turned out, for example, that we got to the end of the year and the return was 3.5%, you could pretty much interpolate between the red squares and the blue diamonds to get a pretty good sense of what the rate would be. So it allows for some short-term budgeting. And also, I think it's a little more of a sort of a practical, easy to understand, and really realistic. What happens if in a single year? I know we had one of our calendar year plans that came in with essentially a zero return for one of their for one of their valuations. And what that meant the next year, the baseline for the second year looked just like the red line from the current year. So we like this idea of doing this scenario test on a fairly short-term basis. And we like to use 0 and double the assumed rate, because then it doesn't look like we're making a projection, a prediction. And then finally, if we know what the return is for June 30 through June 30, 2020, you can use these lines to get a pretty good sense of what next year's contribution rates will look like, including the adjustment for the new assumptions. Now, Andy's going to talk to us about the gray circle, but before, are there any questions just on the sort of the usual scenarios that we show here, the good news of double the assumed and the bad news of 0, and then the baseline in the middle?
One question, you said if we knew, I thought we have it in this month's packet showing that the fund grew by $6 million at the end of June from the prior June. So that's about 1% of the fund, I think. So don't we already know that we're very close to scenario 1 for 1920?
I think I have not seen the packet. I figured that you probably had a pretty good sense. Doris, do we have an estimated rate of return for fiscal year ended June 30, 2020?
I'll let Robert take that.
Yeah, to me it looks like it is below 3%.
Okay.
Yeah.
But above 0?
Yes.
Right. So you're probably then you're maybe not a little bit closer to the red line than to the blue line, but not all the way. Somewhat in the middle, and maybe a little bit past the halfway mark, moving from the blue diamonds to the red square. So the questioner is exactly right. You can get a fair sense of what next year is going to look like once we know that we're in that somewhere in that 0 to 3 range of actual return for 2020, year in 2020.
Yeah. And then of course, when we do that, before we do that, we would take, for example, if the rate of return were to come in at 3, we would also take into consideration other experience items, especially the one item that we will be talking about under scenario 4, where we would expect to see some salary losses, for example, for 2019, 2020. Yeah, but absence that, it's almost like splitting the difference between the red and the blue line on this page 16.
Any other questions on the red, blue, and green before we talk about the gray circle? Okay, Andy, take it away.
Yeah, please. Okay, thank you, Paul. So Paul, if I may ask you to turn back to page 15. So rather than to look at the results, maybe it's actually summarized on page 15. So what happened was when we were talking to the board and Mr. Wilbanks at the time when we present the June 30, 2019 valuation report in the fall of 2019, a concern was expressed by the board as to do with the fact that there were some recent salary increases. I think they were, if I understand correctly, these are not really promotions given to our employees, but rather these were market salary adjustments that were provided after some salary survey were conducted. So those salary increases would not have been reflected in the data that we got for the June 30, 2019 valuation. So I think based on the information we collect from Robert, we understand that there were about a 10 to 11% total salary adjustments. Those salary adjustments would be on top of any cost of living adjustments or promotions that our employees would otherwise receive. But those 10 to 11% increases would actually be provided over a period of 3 years, with about 40% of that to be paid in the first year, another 30% in the second year, and then another 30% in the following year. So what we were asked to do by the board was to provide a idea and a illustration, a projection of what those salary increases may bring to the contribution rate requirement for the plan, and that is actually described on page 15. So I'm just going to read to the board in about the middle of the page, the second to last paragraph. In the next valuation as of June 30, 2020, we would actually expect, again, 40% of those salary increases to kick in. That is going to have expected to have a rate impact on the employer of about 1.48% of payroll. And then we would expect to see the remaining impact will be included in our, not the June 30, 2020 valuation, the one that we'll be working on in the fall of this year, but rather in the coming year. And that contribution rate impact is going to come in at about 0.67% of pay just for that 1 year. But if we look at the total of the 2 years combined in the 2021 valuation, when the full impact of that salary adjustments would be fully recognized, the impact is going to be a little bit in excess of 2.1% of pay, 2.15% of pay, which somewhat coincidentally is about the impact of the assumption changes that we recommend to the board as part of the most recent experience study. So that's what the grayish line will show, is the impact in two valuations. First in the 2020 and then in the 2021 valuation. The impact of first, the 40% of the rate increase because of salary adjustment, followed by 30% impact of the salary adjustments hitting in the 2021 valuation.
I think this is pretty interesting. You know, Andy pointed out that this is roughly comparable to the effect of the assumption change. I looked at it a little bit different way. It's about half as big as having a investment return of 0. So you could say, you know, these salary increases have roughly the same impact as a single year return of around 3%, you know, 3.5 to 3%. Because you can see the gray circle is right in between the baseline and the one that has the 0 return. Now, Andy, check me on this. I think these are roughly additive. So if it turns out that we have a 3% return, which would move us halfway between red and blue here, but we also have these extraordinary salary increases, those two are going to add up and we're going to find ourselves pretty much on the red line, half because of investments and half because of the salary experience. So the fact that the gray line is halfway between and the fact that our actual return is sort of halfway between means that we're going to find ourselves living pretty much on the red line or maybe even a little bit higher. If our actual return, say, is 2%, and we add that to the gray, we're going to be a little bit higher than the red line shown here. Andy, does that sound reasonable to you?
Yeah, I think that would be a good guesstimate, yes.
Now, the other two graphs that show the funded ratio and the unfunded liability, same idea. The gray line just sits right in between the bad news red line and the baseline blue line. Now, this is, I'd say this is not, we're seeing more and more interaction between employers and the retirement systems when they have an extraordinary pay increase to get, you know, a letter from Siegel that tries to estimate how that will affect the next year's valuation. But Andy, I think this is the first time we've actually put one on a projection graph like this. So this is an interesting way of showing, and I think it's quite responsible for the employer to have this information, because, you know, when you give a pay increase, you think it's just the pay increase, but there's also an add-on cost if the pay increase is larger than what we normally assume in the valuation.
Yeah, and I think another point that points that were raised by the board was that it is really our job at the time of the next experience study to make sure that we filter this out, because otherwise it might appear that, why don't we build these one-time adjustments into our salary increases, in the promotion increases, which of course we will not do. But that's something that we will make a look of and make sure that that does not happen when we do the next experience study.
Okay. Any other questions about there? That's really, as far as determinants and projections, Andy, I think that's all we have to say. Then we're gonna we'll pause here again for questions, and then we'll move on to the stochastic stuff.
Yeah. Now I think maybe Paul, one thing that we want to echoed in our report already is even though contribution rates have gone up and as a result of the need to tighten up some of the actuarial assumptions, but I think what this page 16 will help us illustrate to the board. I'm sorry, page 16, when we look at the employer rates, it will show you that the forced funding policy, which is to amortize and pay off the unfunded liability, is actually very effective. So even though we have included a somewhat idealized scenario where either the market earns 0 or the market earns 2 times the assumed rate of 14%, but it will show you that the forced funding policy is actually very effective in making sure that under that idealized scenario that the UAL will be fully paid off, so that the employer will only be paying the normal cost at the end of about 20-year period. So that is actually proof under those idealized scenarios that the funding policy is doing its job.
Another way to see that, I'm going to go now to chart 6, chart 6 on page 17, which is the funded ratio. Same idea. Even if you have a gain or a loss, it changes the path toward the paying off the unfunded, but it really doesn't change when you get there. And this again is because, and we've underlined this in the text of the report, this is because Mendocino Sarah has a robust funding policy that automatically adjusts contributions, so you're always aiming toward that 100% funding at the end of your 18-year amortization period, and in this case, plus the remainder of that restart layer. And we also see that in chart 7 on page 18, same idea. If you have a gain or a loss, it accelerates or decelerates your path over the first 5 years, because that's really your 5-year smoothing, recognizing that, bring that loss in. But then the funding policy ultimately gets you to the same place at around the same time. And that's because of the strength of your funding policy and amortization policy. Okay. So with that, I'm now going to go to stochastic projections. Stochastic projections, when there are some folks who advocate these, especially for plans that are really highly stressed or in trouble, which does not describe Mendocino retirement. They want to make sure the trustees know what are the probabilities of the wheels kind of falling off the wagon here. We were asked in developing the content report.
So we're on page 19, right?
I'm sorry. Thank you, Andy. We're on page 19.
Thank you.
Thank you very much. Sorry, Jerry. So on page 19, we have the text where we talk about, the way a stochastic model works. You basically pretend that you can live the next 20 years over 10,000 times. It's like that movie, the Groundhog Day movie, where Bill Murray lives the next day over and over and over again. Well, here, imagine you could live the next 20 years over 10,000 times, and each time we know that we have a distribution of investment returns, and so we kind of roll the stochastic dice and see what the model says happens in each year, and then you get a distribution of outcomes, and then you can assign probabilities to them. Now, I want to be very clear, I'm a little bit of a stochastic agnostic personally, because even those distributions of returns are based on assumptions. And I get nervous when people say, well, we can't tell you that you're going to earn 6.75, but we can tell you that there's a 58% chance that you're going to have a funded ratio below 70%. Well, that's also based on assumptions. So you need to take these with a little bit of a grain of salt. But what we do like about it is, unlike the deterministic, where we said, here's what happens if you earn 0, here's what happens if you earn 14, we did not assign a likelihood to earning 0 or to earning 14. This is where we introduce the idea of a distribution, so trying to assign a likelihood to these different outcomes. Now we're going to look at the standard sort of graphs that are used to show stochastic results. They involve a lot of percentiles, but then what we've tried to do here is just to pick a couple of sample statistics. So what this shows is that over the next 20 years, there is a 5% chance at the end of 20 years, you will be funded below 50%. Whereas the chances of being below 70%, because that's easier to do, there's a 58% chance, over 50% chance that 20 years from now you'll still be below 70%. But we're going to show you the distributions of those. We tend to highlight the bad side here in this sort of excerpt. We have a similar excerpt here. I'm now scrolling. I'm straddling between pages 19 and 20. And actually, let's then go to page 20. The idea here is, we try to look at, first of all, what is the chance that over the 20 years, we will have a cumulative increase in the employer rate of either 5%, 10%, or 15%. And the other thing that you can look at when you do these stochastic modelings is, what's the probability that in a single year, you'll have a bad enough return, bad enough investments to get a single year spike of 11%, 3%, and 1%. So what we're saying is there's about a 10% chance, 11% chance that sometime over the next 20 years, you'll have a single year of bad return that bumps the employer rate up in a single year by 11%. Now, 11% is a lot, but 3%.
Oh, by 3%, you mean, Paul? By 3% of payroll?
By 3% of payroll. I'm sorry. So you have an 11% chance that it will go up by 3% of payroll in 1 year, but there's only a 1% chance that you would have a single year spike of 7% of payroll. One reason we pull these out, you cannot see these statistics. When we look at the graphs kind of let you see the cumulative effect, but you can't see what are the chances of something happening in a single year. So that's why we pull this statistic out here on page 20 where we are now. So with that,
now I know that Paul, perhaps it's not very comforting for either the trustees or the employer to see that there's a 1 in a 10th chance that the payroll rate can go up by 3%. On the other hand, to give you an idea, why that might be the case is that because of the asset smoothing, right? If we have a bad investment year, we actually won't recognize those investment losses in 1 year, but rather spread over 5 years. And even after going through the 5-year smoothing process and coming up with the value of the smooth value of assets we have in the valuation, that bump in that investment loss year will still be amortized over an 18-year period. So I think that might be the reason why these probability, especially the ones where the contribution rate can go up by 7%, is very infrequent. Nonetheless, it can still happen.
Okay. So now we're going to go to these actual distributions of these results. There's a lot of numbers laid out here. The first one here is the cumulative investment returns. And what this shows is that as you look at longer periods of time, the returns tend to average out. So, but this will at least give us an idea of sort of how to read the graph. First of all, on every one of these graphs, you're going to see a horizontal line. It's hard to see that it's actually a blue diamond. That's always going to be sort of the deterministic baseline. In this case, that's the current assumed return of 6.75%. Then you're going to see a dark purple bar. This is the 25th to 75th percentile. So what we're saying is that in these if we do these 10,000 trials, half of them land in this blue. This is the dark purple bar. And so what this shows is that there's basically the 25th percentile, which is down. It would be 0. So if you put all the returns in order, okay, and 25% of them you have returns less than 0, and then 50% of the time you have returns between 0 and 15. And then there's another 25% chance that you'd have returns above 15%. I'm kind of rounding here a little bit. We're going to see the same kind of distribution all the way through. We only go to We don't show all of the results. We cut it off at the 95th percentile, which is at the top, which means that there's a 5% chance that you're going to have in a single year a return of about, what's that, about 28%. And way down here, there's a 5% chance that you're going to have a negative return of about minus 12%. But if you go out 20 years, because the sort of the law of large numbers and the markets tend to average out over time, go out over 20 years, your distribution of 20-year returns is much, much narrower and much closer to this assumed return of 6.75 in the middle. So again, this just gives an idea how to read these. Now let's start looking at some results. Let's start with the funded ratio. We saw that little table that
now on page 22.
And now we're on page 22, which is chart 9. Thank you, Andy. We put the numbers down at the bottom, and then the graph shows the colors. So what this shows, again, way out here in 2039, there's a 50% chance that we're going to be somewhere between 138% funded, and down below there about a 65%. So that's this purplish range here. Now again, we have assumed that the plan is just going to keep paying normal costs once it gets to 100% funding. But what this shows is there's some material probability that the plan would actually end up at over 100% funding in the end of 20 years. And you can see that same distribution all the way along. So again, there's a 50% chance that you land on the dark purple. There's a 25% chance that you land in the light blue above the dark purple. And there's a 25% chance that you land in the light blue below the darker purple. One thing I like to notice here also, you notice that it seems like the good news is bigger than the bad news here. And the reason for that, quite simply, is when you do these stochastic simulations, you get some extreme results in those 10,000 trials. And the thing is, you can't lose more than all your money. So in effect, the negative returns are limited by the fact that the fund can only go down to 0. Whereas in theory, you could have extraordinarily high returns that would boost your distributions, the high end, as high as you see here. So there's always going to be this sort of asymmetry. The possibility for good news is larger in magnitude than the possibility for bad news, only because in these extreme trials, you can't lose more. You can't have a return of more than I'm going to say this again. You cannot have a negative return bigger than 100%, but you could have a positive return greater than 100%. So you can more than double your money, but you can't lose more than all your money. Okay. Now let's look at. I'm going to go past the unfunded and the funded ratio are just inverses of each other. Let's look at the distribution of future projected employer contribution rates. And now I'm on chart 11, which is on page 24. Okay, now what we're seeing here, first of all, this blue line going across the middle, we've seen that person before. That is more or less the baseline deterministic projection that we saw up in the scenario test. So here in 2032, we see that drop. That's when one of those assumption change layers is fully funded. And out here in 2039, we see the rate, the deterministic rate drop down to the normal cost of 10%. Now this shows us again what the distribution of employer contribution rates is. And again, there's a 50-50 chance. Let's go out in 2031. There's a 50-50 chance that the employer rate will be somewhere between, about 48% up there at the top and about maybe 21%. So that's the range of outcomes that has a 50-50 likelihood for the employer rate. What's interesting is even in the stochastic projection, we still have a very deterministic drop in the unfunded contribution rate from 31 to 32, from 2031 to 2032. So even the distribution of outcomes has this kink in it. The whole set of probability, of probabilistic or stochastic outcomes gets down by that that amount when that unfunded layer gets paid off between 2031 and 2032. Now, unlike the deterministic ones where you can really use this to do some short-term budgeting, this is really just a general sense of what the range of outcomes is. And again, for a plan that has a robust funding policy, like Mendocino Sarah, I don't think that this is really something that you act on. It's more just an awareness of what the distribution of future returns might be and how that might affect the distribution of future employer contribution rates. I think that's so. That's really as far as our projections forward of results, either on a deterministic basis or here on a stochastic basis. That's really the extent of our report. I'm going to pause again if we have any questions or comments. Then we're going to talk just briefly about volatility measures, and that'll conclude our report here.
I have a question about page 19.
I'm gonna shrink the little people out of the way. Page 19. Okay, I have it here, page 19.
Okay, when we were setting the assumed investment return from 7% to 6.75, I believe you guys calculated that there was a 55% probability of our achieving 6.75 over the long haul. And if I'm reading this correctly, it looks like at the end of 10 years, which is not as long term for sure, you're saying there's a 58% probability that our funding ratio will actually go down. So, I mean, I'm just thinking if the two were aligned, if you said there was a 55% likelihood that we will achieve 6.75, then wouldn't we have only a 45% probability that our funding ratio would drop?
Yeah, and this is it's going to be difficult to reconcile these two models. I'm going to apologize for that up front. We are really using two very different ways to assign confidence level here, and they are not strictly consistent. And Andy, now check me on this. When we do these probabilistic models, we actually set the stochastic distributions so that the 6.75 is the median outcome. So it's really two very, I know we use this this percentage as though it were measuring the same thing, but we've actually recalibrated this model because when we do these graphs, I'm scrolling down, for example, to chart 8, okay? We actually deliberately set the stochastic assumptions so that the 6.75 is essentially the 50-50 outcome. So we've actually recalibrated the probabilities to force the 6.75 to land in the middle. Whereas when we were setting the assumption, which is really almost more of a, it's more of a textbook approach. We don't actually use the probabilistic approach for that confidence level when we're doing the main recommendation. But Andy, now let me ask you one more thing. Andy, if you have the experience study nearby, I think that we did do a sort of a probabilistic check on the recommended assumption. Can you put your fingerprints on that? You know, it's at the tail end of the section on the setting the expected return where we use the horizon assumptions. Did we include that in the Mendocino report?
Yeah, we did say that although in the experience study, we were using a 15-year period, not the 20-year that we're looking at right now. We said there's a 56% likelihood that the future geometric returns will not exceed, will meet or exceed the 6.75.
Right. And so the trustee is asking a really good question because we seem to be saying two different things. In the experience study, we said that there's a 56% chance over a 15-year period of exceeding the 6.75. Whereas on this graph, we're showing you go out 15 years and it's a 50-50 number. That is deliberately done because we did not want to introduce into this stochastic study a bias that shows that even if that there's a better than 50-50 chance of hitting the 6.75. So really the probabilities are not comparable. In one case, we wanted, without any sort of without sort of aiming the model to hit 6.75 to see what would happen. That's what we did when we did the experience study. When we come here, rather than having all these numbers sort of trending upwards because we have a better than 50-50 chance of hitting the 675, we've recalibrated the probabilities to make the 675 be the 50th percentile. So the probabilities are really not comparable between this study because we basically jury-rigged these downward to make the 50-50 be the 6.75.
I hear what you're saying. I'm just not on. If we go back to chart 19, I don't understand why it's still showing a more than 50% chance that the funded ratio would go down.
I'll go back up to let me get the pictures out of the way. Well, let's look at the distribution of funded ratios here.
So page 22.
Yeah, I'm on page 20. Yes, page 22. So Andy, I guess the question is that statistic that we excerpted up on page 19. Help me find where we're going to see that here on page 22, if we can find it here.
Yeah, so I think we said on this page, all the way out to year 2039, there's a 5% chance that the funded ratio would come in at about 4.6, call it 65%. So now I'm going to page 19.
So on page, and on page 19, I think the question is, and make sure I'm looking at the right statistic here, that there's a 58% chance it will be below 70%, right? So let's see here. So 70% is right in here. And I have to admit, I'm having trouble finding that statistic on this graph. I think we may, in the interest of time, it is possible. It's possible that the number on page 19, we may need to take another look at that. I apologize. I can't really. I tend to focus more on this whole distribution, but how that funded ratio below. Oh, you know what it is? Oh, I know exactly what it is. The thing on page 19 is the probability that the funded ratio would fall below 50, 60, or 70 at any point in the next 20 years, whereas the graph here is showing a cumulative distribution. So I think that's, it's similar when we were talking about the effect on the contribution rate. It's one thing to look at what the distribution of the return of the contribution will be in 20 years, but it's something else to say at any point along the way, what's the chance that we have some particular set of outcomes that leads us to a point in time where we have a funded ratio below 70%. So I think that's the reason we can't see this here. This doesn't show the individual trials. And what we're saying is that there's a 58% chance that at some point along the way, you might be below 70%. But that doesn't mean that by the end of the 20 years, you would not have recovered back to the distribution here. So I think that's what threw us off, is on page 19, this is not what is the chances that at the end of 20 years, you'll be below 70. It's only that at any point in time during those 20 years, that you would swing to a point in time snapshot of being below 70%.
Okay, I appreciate the answer. Thank you.
Yeah, that's and Andy, let's make a note. These point in time ones, I mean, I think it's good to let folks know what that is, but maybe we need to be a little bit more clear when we pick our example on page 19. By the way, these risk reports are very much something that we learn through doing.
Right.
And so this is our first year doing it here. So maybe we need to be a little bit more clear on page 19 that that's a point in time measure, not a accumulated measure. So that's a really helpful question. We will definitely put that into our design of the report going forward.
Right. So in other words, Paul, this is the 10,000 trials that we were talking about for each of the next 20 years. So they're really 200,000 years that we're looking at. So we're just trying to figure out of those years under observation, how many of those have a funded ratio coming in below 70%.
Yeah. The thing is, on page 20, when we're talking about the employer rate, we show both. We show the total, what are the probabilities that would increase by 5, 10, or 50% at any point, and then we do the single year spike. Yeah, so I think that we just need to be a little bit more clear on pages 19 and 20. Those are both at any point indicators, and not these more cumulative indicators that we see here. So let me go here. Yeah, so Mr. Dirty, that's really very helpful question, because we just want as we present these with other plans as well, we will be more clear about that distinction between these accumulated measures like on the graphs and this sort of single point in time samples that we pulled out in those excerpts on pages 19 and 20. So we do appreciate that. Okay. With that, I think we will now go to the last section of the report, which talks about what are called plan maturity measures. I'm now going to page 25. And these are things that already appear in your full valuation report, but we've expanded them a little bit here. We start off by looking at what are called support ratios sometimes. This is just comparing the... Yeah, you'll see there's a page in our actual report where we compare the number of members in pay status to the number of actives. You'll sometimes hear that described as a support ratio. For a system, a pay-as-you-go system like Social Security, that's a crucial measure, because the active working members in the economy are really providing the benefits to the retireds in Social Security, which is essentially a pay-as-you-go plan. That's not the case here, because by the time the members retire, the benefit is largely funded. And so that's why we show these, but they basically don't indicate that the plan will get more expensive. They indicate that the plan will be more volatile. And then to drill down on that, we have something called an asset volatility ratio. Again, I'm still here on page 25, just looking at the text. The asset volatility ratio simply takes the market value of assets divided by payroll. The liability volatility ratio takes the accrued liability, not the unfunded, but the entire accrued liability, again, divided by payroll. And the reason that we do that, we mentioned this in the text here on page 25, but I'll go to page 26 where there's a little table. And the thing about these volatility ratios, a little tricky to get your hands around, but we look at the table on page 26 and we say, for example, for the general, I'll look at the total plan combined down to bottom. The asset volatility ratio is 7.5. That means that the plan assets are 7.5 times payroll. Okay. Well, that means if you have a 10% asset loss, if you take that times 7.5, that means that that equals 75% of payroll. Now so that means if you have a 10% asset loss, eventually you're going to have to get contributions that total 75% of payroll. That's for the entire plan. But if you break it out between general and safety, for the general members, the assets are only 6.7 times payroll. Whereas for safety, it's about 10.9. So that means the very same 10% asset loss is going to translate into 2/3 of a year of payroll for the general members, but over a full year of payroll for the safety members. That's why whenever we have investment experience, it seems to cause more volatility in the general contribution rate than it does in the safety contribution rate. That's what this thing is trying to show. On the liability side, I usually use the example of, it shows here a 10% loss, but what if we had an assumption change that increased liabilities by 10%? Okay. Well, in that case, for the general members, because the liability is about 10 times payroll, if you have a 10% change in liability, either because of a loss or because of an assumption change, well, 10% of 10 is 1, so that's roughly a full year of payroll. But look how different it is for the safety members. For the safety members, the liability is about 15 times payroll, a little more actually. So if you have a 10% loss, that's going to be 150% of payroll. And this is why when we, for example, in the last experience study, if you look at the effect of the assumption changes on the plan in total, you get one answer. But if you look at the effect of the assumption changes for the general rates compared to the safety rates, the safety rate impact always seems to be about half again as big as the general impact. And that's really because the safety tier is more mature. It has a liability that's 15 times payroll, whereas for the general members, liability is about 10 times payroll. So we've mentioned this in the regular report, again, just to show why it is that whatever happens, it seems to have a greater impact on safety. The safety rates are generally more volatile than the general rates because the safety tier is more mature than the, and also larger benefit than the general. So I'm going to show this in a couple of graphs. First, I'm now going to chart 12 on page 27. And the real point here is to show how the plan is getting more mature over time. We've got two different ratios here. The sort of red diamond includes all non-active members, retireds and terminated vesteds. These are people who have quit service with your employers but have a deferred benefit, a deferred claim. That's what we used to always show in the actuarial report, but really it's the retirees that drive the liability and drive the maturity of the plan. So what we've shown here instead, this green diamond, sorry, the green triangle is the members in pay status divided by the active members. And back in 2010, we had fewer retirees than we had active members, about 85%. 2011 is where it crossed, where we had the same number of members in pay status, retirees, as active members. And now it's fairly flat with about 12 retirees, 12 or 13 retirees for every 10 active members. But this just shows a steady progression of the plan getting more mature, which means that your experience will be more volatile. This sort of shows it in a way that people find easy to understand because it's just head count. But to really see how volatility affects the different tiers, we're now going to page 28, which is chart 13. It's got 4 lines on it. The combined, which is the blue diamonds, this again is the asset volatility ratio. And this is where I was showing that for safety and probation out here in 2019, they have a much higher assets to payroll ratio. And that's why investment experience has a bigger impact on the rates for safety and probation. And then a similar graph, if I now go to page 29, which is chart 14, this is now the liability volatility ratios. And again, what we saw was that the safety members, because they have higher liability compared to payroll, they're just generally going to see more volatility, whatever happens. And we can also see here there's just a general trend toward more mature. Now, Andy, I'm going to put you on a spot here. We see that the in the last couple of years, the probation volatility ratio here has gone up rather dramatically. Do you have a particular narrative on that one?
I think especially in the last valuation, if I remember correctly, the payroll and headcount for the probation have come down, whereas for the other groups, they have gone up.
Ah.
Yeah, they're just fewer. I don't think we are quite back to the pre-housing bubble crisis, but at least there were some more hiring especially from the county for the general membership and the safety, but not necessarily so for the probation.
Well, that's very interesting. You know, I tend to think of this, you know, again, this is liability divided by payroll. I tend to think that when it changes, it's because the liability is changing, but of course it can go the other way. Yeah. So the reason that these other three ratios have come down slightly in 2019 is not because the liability went down, it's because the payroll went up. But we did not see the same sort of recovery in the probation payroll, and that's why this has gone up. So I need to tell myself, you know, this ratio can change because the liability changes, but it can also change because the denominator, the payroll, is changing. Thanks, Andy. So this brings us to the end of our report. The appendix lists all the assumptions and stuff that we have in there. But again, this is the first, a lot of information to sort of have you drinking out of a fire hose here. But we're trying to, you know, give you a sense of how we got to where we are. That is how past risks have defined where MSERA is today. And then with both a deterministic and stochastic looking forward to see expected outcomes in the future. And then with these maturity ratios, just a general sense of why we're seeing a general trend toward more volatility in the contribution. And Madam Chair, this concludes our prepared remarks. I know it's a lot of stuff to absorb. We really appreciate the investment that Mendocino Sarah has made, because we think that risk is it's a key concept for trustees. I know sometimes you feel like, yeah, but what can we do with it? You know, to some extent, it's as much an awareness as an action item. But the thing about the deterministic projections, that does, at least in the short term, provide some perhaps some budgeting information for your employees.
Well, thank you very much for all this information and giving us a heads up of, you know, the more of the intricacies of what's going on. And we really appreciate it. Thank you, Paul. Thank you, Andy. As always, we really appreciate everything that you do for us.
Well, it's our great pleasure to be your actuary.
Thank you.
Okay.
Okay, with that, shall we say goodbye? Or
Andy, is there anything else on the agenda that you'll need our attention for? I don't believe so.
Right. Yeah.
Okay. All right. So thank you very much. So we'll sign off.
Okay. Thank you.
Okay. Thank you. Bye-bye.
Bye-bye.
Thank you.
Bye.
hey, do you like to take a break, like a 15-minute break now, and be back? And let's see, it's 10:10, 10:25. Is that okay with everybody? Do you need a break, or do you want to just continue on? What's the board's pleasure?
I need a break.
Okay. Anybody else? It's okay. You want a 10-minute break or a 15-minute break?
10's fine.
10.
Okay. So we'll be about 10:20. We'll be back. Thank you.
Thank you.
7:22. And I just wanted to announce that Richard had to leave the meeting and he will not be returning. And then I'd like to go forward and to regarding the investment matters and hand it over to Robert.
Good morning. Hi. So you do have a preliminary a preliminary investment report for June. Callan will be here next month to give a full update, but this kind of gives you an idea of what's going on. Like I did mention in my memo, there is a large overstatement on our AB US Small Cap Growth Fund due to timing. This meeting just being as early as it is in the month compared to other meetings. So that is kind of the one thing I did want to note. I also want to jump back to the comment that Dan made about the investment portfolio. And so, Dan, while you are definitely correct that the market value of the assets increased that $6 million, which is the 1.19% that I referenced in the budget update, the investment income that Siegel is actually going to use to do that calculation, that number is going to come from the net investment year-to-date income line on our statement of net changes report for the monthly financials. So if you look at the monthly financials for the end of this month, year-to-date, you'll see that the net investment income is a little over $15 million. That number is going to be the numerator when Siegel calculates our investment return. And as of right now, with those numbers, that investment return is at a 2.826% return for the year. So Dan, I just kind of wanted to clarify that for you. You were right on with that. It was just you weren't grabbing the right numerator in that mental calculation you were doing there. Any other questions?
Okay, if there are no further questions on that, can we move forward to the quarterly budget update, agenda item 5?
Yeah. So in front of you, you also have the quarterly budget update. I attempted to go into as much detail as I could there for you. I leave it open to you. If anybody has any questions, I'd be happy to answer them.
Just thank you for the nice explanations that you put in, nice footnotes. Makes it very easy, and so we don't have questions. Thank you.
Yeah, and again, this is preliminary, but the majority of the expenses are in the system, so there shouldn't be any major breaks or changes here.
I just want to echo that comment, Robert. I think you did a really good job with the summary. I appreciate it.
Thank you. Thank you.
So if there are no further.
Could I ask a quick question?
Yeah.
Both Robert and Dan, are we seeing any reduction in the county's contribution because of are people off work because of the virus and not being able to come to work, or is everybody being relatively fully paid and our county contribution staying static?
From what I see, everything is the same. Yeah.
And Dan?
Contributions are right where they should be. There's been no disruption there.
To my knowledge, employees have not been furloughed. I do know of other local governments where some employees were furloughed. I believe that employees, if they're, say their department or their office was shut down to the public, say the libraries, that they were working either in the library doing some other preparatory work, or they're working in other areas of the county on maybe COVID related issues.
Thank you. That's good to know, Dan, that we haven't had to go there, and hopefully we won't. If there are no further questions regarding the budget update, I'd like to move on to agenda item 6. We have 2 resolutions, agendas item 6 and 7, and turn it over to our executive director, Doris.
Thank you, Madam Chair. Both of these resolutions are to account for a new pay code in use at the courts required because of the COVID-19 crisis due to some federal legislation. As such, this pay, similar to the one adopted for the county a month or so ago, is deemed to be pensionable, and we're asking for a motion to adopt the pensionable pay resolution.
Is there a motion?
I'll move to adopt the resolution as presented.
Second.
Could I just ask a question on that resolution? I see there's another pay code in red, uniform allowance 525. Should we discuss
Yes.
that at all?
That actually is a correction of a mistake that occurred back in 2019, where it was accidentally moved on the list of comparable pension, comparable for our legacy members to non-pensionable in error. That actually has been pensionable this whole time. It's just to fix that error.
Is there any other discussion on the motion? Judy, can you please take a roll call vote?
Yes. Ms.
Was
Shatmeyer?
there?
Oh, I'm sorry, Jerry, go ahead.
No, I didn't hear a second. I was just asking who seconded the motion.
Julie Forrester.
Okay, thank you.
Okay. The motion is to approve the resolution 2020-06 as presented. Ms. Okay, Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker?
Yes.
Smith?
Aye.
Mr. Cromer?
Aye.
Mr. Knudsen?
Yes.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
Thank you.
Motion passes unanimously. Moving on to resolution, is the resolution number, it's item number 7, resolution 2020-07.
Yes, this is for the PEPRA definition of pensionable compensation. Again, addressing the new Superior Court pay code for the COVID-19 pay. Again, this would be included as compensation, PEPRable. For PEPRA members, it would be pensionable compensation.
Is there a motion?
Move to adopt resolution 2020-07 as presented.
I'll second.
Is there any discussion on the motion? Okay, all those in favor, Judy, if you could do a roll call, please.
Yes. Ms. Shatmeyer? No. You're muted. Yes.
Aye.
Thanks. Ms. Forrester?
Yes.
Ms. Cavanis?
Yes.
Mr. Parker? Mr. Parker? Ms.
Yes.
Kathy?
Yes, sorry.
Thank you. Mr. Cromer? Mr. Knudsen?
Yes.
Ms. Harris?
Aye.
And Mr. Jurdy?
Yes.
Thank you.
Motion passes. And moving on to agenda item 8, the strategic plan. Again, I would hand this over to our executive director, Doris.
Thank you, Madam Chair. Again, it's time for review of the strategic plan. It does appear that the last in-depth planning sessions were done in 2015 and 2017. So I realize there might be a couple of members on the board who were not involved in those deep dives into the crafting of the strategic plan and the missions and values statements. Today's really a discussion to gauge the board's interest in doing a more deep review of the strategic plan and setting of strategic priorities, or if the desire is to carry forward the current priorities and items as currently presented in your work plan. And of course, as items are completed on that work plan, new items will take their place based on the ranking of topics that the board did a couple of years ago.
I would like to comment that in my work experience, we would always review the strategic plan at least every 5 years and see if we need to change it. But I think, Doris, for you, I mean, it's kind of up to you, in my opinion, because do you want to work with this strategic plan for a while first before we go through a process to talk about it? Do you want to get more familiar with them, Sarah, before we look at this and maybe in 6 months look at it again? Or it's kind of how you're comfortable, in my opinion.
I'm perfectly happy to work with the current strategic plan, and we certainly have lots of projects to work on. At some point, it would be nice to review items with the board to see if any of the priorities or projects that had been on past work plans, if any of those priorities have shifted and they need to be reprioritized and put into a different order. But certainly there is a lot going on right now that is requiring the focus of staff as we move forward with the current work plan. I'm happy to continue that and then address this in 6 months or a year, even as other things wrap up and we have more time to focus with this. But it's at the pleasure of the board.
I'm okay with that. I want you to be able to have a plan that you can work with.
I can certainly work with the plan that's there.
Well, Dan.
Yeah, so first of all, I also appreciate the fact that Doris, that you brought this up and didn't just put it off to the side. But I like Kathy, I was thinking that you would probably benefit from working with the existing plan for at least a few more months, maybe coming back to the board in January and seeing how things are at that point, scheduling something during the next calendar year 21.
Showed up on our calendar for review for the board now, so I wanted to put it out there, and whether we do it over a period of months, since we're not necessarily going to be doing like a day or two planning session that's offsite where everybody can get together due to the current circumstance, it might be something that we address a little piece of it over several months at a regular board meeting to craft the final plan. But again, I am new. I haven't had a lot of chance to get in with the current board work plan and see how progress is being made there with the existing projects. So I'm more than happy to let this wait a little bit till I get a better sense of the progress we're making on the current work plan and bring this back at a future date.
Sounds good to me.
I don't believe it required a motion, but Jeff could confirm that. It's just direction, is it not, Jeff? Or I'm sorry, there was a comment from a board member?
No. I just wanted to say that it sounds good, and that because we are in a very uncharted period in as far as with the influence from COVID, we might from time to time need to check in as you proposed anyway, to review portions of the strategic plan from time to time at our regular meetings.
I think direction is all you need.
So direction to staff then, from staff, direction to our executive director to proceed as discussed with our strategic plan. And then moving on, the next agenda item 9, the board work plan as well, to our executive director. I'll defer to you for that.
Thank you. Again, I was following James' lead and brought back the same format for the presentation of the board work plan that you're already all familiar with. The leadership transition essentially is complete with my coming on board, and that will fall off the next quarterly report. We are essentially on track with maintaining our review of policies and the current work on our big project for review. We, of course, have paid our benefits on time as always. And as one project wraps up, probably the next project, and we'll talk about this again further, would be adding, excuse me, a comprehensive risk assessment, probably by hiring an outside auditor to review MSARA's practices, policies, and ensure that we're following our guidelines appropriately. So that would be one of the larger projects that would be upcoming if the board still has interest in pursuing that one. Again, everything looks reasonably on track. Nothing significant has changed as far as a downgrade in any project. If you have any questions, I'm happy to field any questions.
I just have one question. I just happened to notice that it's still called the 2019 work plan. Would it make sense to label this 2019 and 2020 work plan?
Yes, I apologize. One of the versions I didn't get changed here was changing that to the 2020 work plan. But you're right. The last two plans that the board had seen also continued to reference 2019, but it should be either 2020 or 2019, 2020. You're correct.
Madam Chair, I would like to see us talk about bringing in an outside risk assessment expert in the future. I may be the only one who's interested in that, but that's an issue for me.
That sounds like a very good plan. Include that in addition to our independent auditor.
I'd want to see what that costs.
Yeah.
Yeah, absolutely.
I mean, there's a cost benefit ratio, and it's our members' money just to make ourselves feel good. So,
well,
no, that's not what it's about.
I would probably perform an RFP and bring the proposals to the board so the board has input on, first of all, crafting the scope of the RFP, but then also selection of the vendor and setting of the budget associated with it, because I am very cost conscious also, Mr. Parker.
Thank you. So we'll give direction to staff, to CEO, to executive director to go forward with research on a vendor for performing a risk assessment.
Thank you.
Okay, and then we'll move on to agenda item 10, retirement administrator performance evaluation. I think that that is something that is all we're going to do here is look at some modifications to the current evaluation policy, replacing retirement administrator with executive director.
That's correct.
So is there a motion to make those changes? And there's also a new amendment date, which would be today. So I need a motion.
Motion to approve the new executive director performance evaluation policy.
I second.
All those in favor? Would you please-
We have to do a roll call, sorry.
Yeah,
Meyer,
Yes.
Ms. Forrester,
Yes.
Ms. Cavanis,
yes.
Mr. Parker,
Yes.
Ms. Smith,
Yes.
Mr. Cromer,
Aye.
Mr. Knudsen,
Yes.
Ms. Harris,
Aye.
and Mr. Jurdy.
Yes.
Thank you. Approved.
Approved. And agenda item number 11, the administrative report.
Thank you, Madam Chair. Just as an update, due to COVID-19 precautions, we have divided staff into two separate non-overlapping work groups. So in the event that a staff member does become infected, that they can only take out half the work group and the rest of us can keep MSERA business functions operational. So we're using a combination of in-office work and telework, with the groups keeping segregated days.
And that's working out very well.
This is our second week and it seems to be working out well. Then under administrative and operations issue, the board bylaws are due for review. With the board's permission, I would like to postpone and review, take the bylaws under review early next year to give us an opportunity to wrap up some of the other projects we're working on before we make any modifications to the bylaws. And there's some information on the Sackers legislative proposal. If the board wishes to submit any legislative requests for consideration, the deadline is August 30th.
Well, I don't believe we have any legislative proposals, but we still have a little bit of time. If, let's say someone came up with a proposal before the next meeting, we could bring it up, we could put it on the agenda for the next meeting, correct?
Yes.
Okay. Do we, Jeff, do we need to vote on the bylaws, like postponing the bylaws, or is that just directing to staff?
I do not think you need to vote.
Okay. Well, thank you very much, Doris, for the administrative report. And I guess, Jeff, we're going to go into closed session now.
So before we go into closed session, does anybody have any abstentions or announcements?
I will be recusing myself from the Michelle Mayfield disability case discussion because we both have members of our immediate families that are closely related by marriage. I hope you heard that.
We did.
Thank you.
I have a question. Are we getting a second Zoom link or something for our closed session? Okay, we just stay on here. Is that it? Okay.
Yes, the video will stop. Scott will stop recording and we will have time to do closed session.
So we're going to go into closed session now.
Met in closed session and considered the two cases on the agenda. In Boyd Nolan, the board voted unanimously to grant a service-connected disability retirement. And in the Michelle Mayfield case, the board voted unanimously to deny the application for a non-service connected disability retirement. And trustee Shatmeyer abstained from the Mayfield vote.
Okay, on that note, is there a motion to adjourn?
So moved.
A second?
Seconded.
Okay. All those in favor?
Aye.
Aye.
Okay, motion passes. Meeting is adjourned at 11:07 and our next meeting will be held on August 19th.
Good to see you all. Stay well.
Bye, everyone.
Thank
Stay
you.
cool, everybody.
Bye.
Bye, you guys.
Bye.
Thank you.
Thank you.